Think about it. Every single day we're making decisions without really knowing what's going to happen next. Should you take that new job? Should you invest in that stock? Heck, even should you leave for the airport now or in 10 minutes? Today, we're digging into the frameworks that can help us move beyond just a gut feeling and towards a real quantitative strategy for dealing with an uncertain world. Okay, let's jump right in.
So I want to start with a simple question for you. Imagine you have two choices. Option A, I give you $50, guaranteed. It's yours, no strings attached. Option B, we flip a coin. If it's heads, you get $100. If it's tails, you get nothing. So which one do you choose? Think about it for a second.
So here's the fascinating part. On paper, mathematically, both of these choices have the exact same expected value. You know, a 50% chance of $100 averages out to $50. But my guess is a lot of you picked the guaranteed 50. It just feels safer, doesn't it? It feels more valuable. And that feeling, that's really at the heart of all of this. It's the thing we have to learn how to account for.
Right, so how do we actually put a number on that gut feeling? Well, this brings us to our first big idea. We have to understand that the value of a dollar isn't always, well, a dollar. It really depends on the situation and who you are.
And that leads us to this powerful theory called expected utility. It basically says that when we make choices, we're not actually trying to get the most money on average. What we're really doing is trying to get the most personal satisfaction, or what economists call utility. At the end of the day, we're not maximizing dollars, we're maximizing our own sense of well-being.
And we can thank the brilliant Daniel Bernoulli for this insight. He was the one who pointed out that, hey, winning $1,000 is a life-changing event for someone with nothing in their pocket. But for a billionaire, it's a rounding error. The value of money isn't a straight line. That extra dollar is always worth just a little bit less than the one that came before it.
All right, so we've established that how we feel about risk is a huge deal. So now let's look at how the pros take this idea and run with it, using two totally different ways to model and measure risk.
So here's the next big question, right? If we agree that risk is more than just numbers on a page, how do we get a grip on it systematically? How do we go from just a vague feeling of danger to something concrete that we can actually work with?
Well, one way to do it, and this is super common in finance, is something called modern portfolio theory, or MPT. You can think of this as trying to drive by looking in the rearview mirror. It's all probabilistic. It just chews up tons of historical market data, past returns, how much prices bounced around, to try and guess what future risk will look like. But here's the big catch. It just assumes the future is going to look pretty much like the past. And it doesn't tell you why something bad might happen, just that it might.
Now contrast that with a totally different approach, probabilistic risk assessment, or PRA. This is a forward-looking, structural way of thinking. And this was born out of something with, unbelievably high stakes, nuclear power safety. Instead of looking backward, PRA starts with the most fundamental question you can ask: what can go wrong? It actually builds a model of the entire system piece by piece, so it can figure out the odds of disasters that have never ever happened before.
And PRA gets super granular. It breaks risk down into these three levels. So first, you model all the different ways an accident could start. Then you analyze what would happen during that accident, what kind of nasty stuff might get released. And finally, you calculate the real-world impact, the actual effect on public health. It's a complete bottom-up picture of risk.
Okay, so you've done the work, you've sized up the risk, and you've embraced the uncertainty. Now what? You have to act. When you find a good opportunity, how much of your money do you actually put on the line? How big of a bet should you make?
Well, for that, there's this really elegant bit of math called the Kelly criterion. It was actually developed by a researcher at Bell Labs, and it's a formula specifically designed to give you the answer to tell you how to maximize the growth of your money over the long run. And what's so powerful about the Kelly criterion is how precise it is. It doesn't just give you a vague idea. It calculates the exact, optimal fraction of your bankroll to put on a favorable bet. It's all about finding that Goldilocks amount. Not so much that you risk blowing up, but not so little that you're barely making a dent.
Okay, let's make this real. Imagine you're betting on a football game. You've done your homework, and you think one team has a 60% chance of winning, and you're getting good 2-to-1 odds on your money. You pop those numbers into the Kelly formula, and boom, it tells you to bet exactly 20% of your total bankroll on that game. It's a totally disciplined mathematical way to manage your position size.
Okay, so we've talked about utility, a couple of risk models, even how to size your bets. Now let's see how all this stuff smashes together in the real world during one of the most high-stakes events in finance, a company's quarterly earnings call.
And there's this really clear, predictable pattern.
About 10 days before a company announces its earnings, you see uncertainty and trading volume in the options market just start to climb, day after day. It hits this fever pitch the day right before the announcement. And then, bam, the second the news drops, all that uncertainty just vanishes and trading volume falls off a cliff.
And we can actually see this in the data. This chart shows what's called implied volatility, which is basically the market's price tag on uncertainty. And it's way, way higher during the month of an earnings call than it is the month before or the month after. The market is literally pricing in the fact that nobody knows what's coming.
So what's the big find here? Well, it turns out that all that activity in the options market can actually predict whether the earnings news is going to be good or bad, but only for one day. The signal only shows up the day right before the announcement. Basically, the smart money is moving, but it all happens in this super, super tight window before the rest of us find out.
All right, this brings us to our last big idea for today. And honestly, it might be the most important one. We spent all this time talking about how to manage and measure uncertainty. But what if I told you there's measurable value in actually embracing it? There's actually a name for this concept, the expected value of including uncertainty, or EVIU for short. It's the quantifiable, measurable benefit you get when you run a full analysis that includes probabilities instead of just using a single best guess and pretending you have a crystal ball.
So here's the bottom line. Ignoring what you don't know might feel easier, but it often leads to some really bad decisions. So, admitting you don't know something and actually building that uncertainty into your models, that's not a weakness. It's actually a huge strategic advantage that lets you make much, much better choices.
So I'll leave you with this one question to think about. We all love simple, certain answers. It feels comfortable. But the next time you're making a big decision, just ask yourself, what's the hidden price I might be paying for being so sure that I'm right?